Hi friends, welcome back to Bank Express Academy. Today we are discussing a major update from the Income Tax Department that's set to change how tax enforcement works in India. Starting April 1st, 2026, tax officials will have the authority to access taxpayers' digital communications, including emails, social media posts, and even cryptocurrency records. You might be already aware of this move by the government, but let's see what are the details, what this means for you, how it works, and what safeguards are in place to protect your privacy. This move is part of a broader effort to tackle tax evasion in an increasingly digital economy. With more financial transactions happening online, traditional methods of tax scrutiny are not always enough. The government aims to bridge this gap by updating Income Tax Act and the Information Technology Act, giving tax officers the tools to investigate digital data when there is credible suspicion of tax evasion. So, what exactly empowers tax officials to access your digital data? Recent amendments to the Income Tax Act 1961 and the Information Technology Act 2000 grant them this authority. But don't worry, this is not a free for all. There are strict safeguards in place to ensure that your privacy is not violated. Here is how it works. Tax officials will need prior approval from a senior authority like a principal chief commissioner before accessing any data. They will also need to demonstrate reasonable cause like suspicion of tax evasion or underreporting of income. Once approved, they will issue a notice to both the taxpayer and the digital platform provider. Which platforms can they access? Pretty much anything that might contain financial information. Emails, social media accounts like Facebook or Instagram, messaging apps like WhatsApp, bank accounts, trading platforms, and even cloud storage services like Google Drive. Now let's talk about safeguards. The government has emphasized that strict protocols will protect your privacy. These include judicial oversight, independent audits, and the requirement that data access is used only for tax purposes. Taxpayers will also be notified in most cases unless it risks compromising the investigation. But what if discrepancies are found? If tax officials uncover inconsistencies between your declared income and the data they access, you could face reassessment, penalties, or even legal action for tax evasion. That's why it is crucial to accurately declare all your income and maintain proper records. In fact, India is not alone in this move. Countries like the US, UK, and Australia already have similar provisions to combat tax evasion in the digital age. This aligns India with global practices, ensuring that tax enforcement keeps up with modern financial realities. So, what can you do to stay compliant and protect your rights? 1. Accurately declare all your income in your tax returns. 2. Keep proper documentation of your financial transactions. 3. Be aware of your rights and the safeguards in place. 4. If you receive a notice from the Income Tax Department, verify its authenticity and, if required, consult a tax professional. Small businesses and individuals might feel the impact of this rule, especially if their financial activities don't align with their declared income. But if you are transparent and compliant, you have nothing to worry about. In the long run, this provision is expected to increase tax compliance, reduce evasion, and modernize tax enforcement. It's a step toward greater transparency in financial transactions, but at the same time, it also raises important questions about our privacy and the balance of power.